Well, good morning, everyone. Great to be back here in Milwaukee. I don't know where Dan went. I guess he's getting food now, but it is the 21st time I've done this. I think he's got to upgrade the program next year. But anyway, I'm looking forward to the gold watch, Dan, at the end of today. So I got a few, before I confess to how bad my predictions were last year, there's a few things. I got some bonus observations. Great ending to the football season for the Packers. I'm sure you all enjoyed the Vikings getting bounced in the first round of the playoffs. I mean, that's as good as a Packer win, right? 13-4, yeah, right. Aaron Rodgers, wow, it's been a good run, but I think he's playing for the Raiders next year. That's my prediction. Aaron Rodgers to the LA Raiders. The Packers will finally realize home field advantage with a finesse passing team doesn't work that well in January in Green Bay. So we'll have to get a quarterback that can do some run-pass option, and that'll be better for the Packers long run. Another thing I'm not going to talk about in my presentation, but merits some comment, crypto and NFTs, it is the greater fool theory. Warren Buffett is right. You know, it doesn't really solve a problem that anyone has except criminals, right? So I don't really see a great future for it. We're seeing fraud around the edges, you know, everything was transparent until it wasn't. So I don't really see how that goes on too much longer, but all right, so those are your bonus predictions. Oh, you've got a clock for me too this year, I like that. Okay, sometimes I go on too long, warning to my fellow speakers now. I'm going to review my 2022 predictions, as I always do. They were terrible. I will review the actual performance of the economy, and then I'll give you my outlook for 2023 and beyond, and we'll compare my forecast with what I got when I typed in a request to ChatGPT. Okay? So 2022 predictions. This is what I actually said on the money slide last year. We can still thread the needle on inflation and recovery, but uncertainty makes it a wild ride. Real GDP was going to grow by 3.5%. What was I thinking? Unemployment will be below 4% with greater labor force participation at year end. That latter part hasn't really healed as much as it needed to, and that's why I was a little overly optimistic about GDP, and I was way too optimistic about the rate at which inflation would come down. Of course, I didn't really know Putin would invade Ukraine, so that kind of added some additional supply shocks and wrinkles that kept inflation higher for longer. But it is coming down at a pretty good pace right now, and it'll be very, you know, we should know in a few months' time, you know, how much work the Fed is really going to have to do in raising interest rates. And I've got my own way of, my own analysis on that, and we can get to that toward the end. I thought the S&P would end lower than we started due to the rate hikes, but still think investing in U.S. equities is the great long-term investment. We're still an incredibly dynamic economy, and I think ChatGPT is the tip of a big productivity revolution that will come. Eventually, there'll be a lot of uses of artificial intelligence. So I still think good times are ahead, and the U.S. remains a very dynamic and competitive economy. You know, I wish our public sector could you know, operate at the level our private sector operates in this country. That's one thing that is a bit of a risk for us. So what did we miss? The Russian invasion of Ukraine added to those pandemic supply shocks. I didn't think China would go with the zero COVID policies as long as they did. So that again kind of kept the supply side of the economy laboring more than expected. And the heightened U.S. tension with China and just the effort to shift business away from China elsewhere just creates a lot of frictions in markets, and you know that creates further supply side pressure. And then the U.S. labor supply never got back to pre-pandemic levels of participation. In particular, older workers really haven't come back. I expected, you know, and there is a meaningful amount of labor force now that is people over 65. Participation rates for over 65-year-olds had been up around 20%, above 20% for a while. That's no longer true, and I thought you'd see people coming back just to deal with inflation and the depressed equity levels, both those things kind of working to maybe force people to generate new income. But that didn't happen, and low-wage workers haven't really shown back up in the workforce, especially in high-density urban areas. So this is really where it added up to this miss on inflation, underestimating how high inflation would remain by year end, and overestimating growth. So that was the problem. I'll give you a quick tour through the data now, but I really want to focus on, I think, how we look back and think about the pandemic and what the challenges are ahead. But the reason the economy is not in a recession, even though we technically did have 2 consecutive quarters of decline, the unemployment rate, it's as low as it's been for the last 40 years. So this is not a recession economy at this point, and I don't know that we're going to have one. Payroll employment is back above the pre-pandemic peak, but of course population of working age is also quite a bit greater, and participation rates haven't actually come back. So there should be, if we had pre-pandemic labor force participation, another 2.5 to 3 million workers in the workforce. That would either make employment higher or unemployment rates higher, but they're not there. I don't know where they are. I don't know if they're working for cash somewhere. That does seem to happen where I have my lake house in northern Wisconsin. A lot of people work for cash. I don't do that, but. So here's the labor force participation slide, and you can see for prime age workforce, 25 to 54, that's the top panel, we're still 2.5 percentage points behind the highs in participation around the year 2000. We are almost back to the pre-pandemic peak, but it started to go the wrong direction again. And then the lower panel is people over 65, and you can see there, that's been a big development. Their participation rates used to be quite low. They grew dramatically over the last 20 years. People are living longer. Maybe retirement was overrated. So a lot of people over 65 do continue to work to some degree, but that dropped off with COVID, largely out of health concerns, I think. And it hasn't really come back. And like I said, I thought it would come back more strongly with inflation and depressed equity prices, but not yet. So that remains a bit of a mystery. Real GDP growth, it's sort of back down to normal levels, right? We had the big recession with the pandemic initially, then a big bounce recovery, very strange pattern, nothing like it in 40 years of data, as you can see. Now we're going to settle in at steady GDP growth rates. Maybe we have a flirt with a recession this year, but even after that, I think GDP growth is going to be much more moderated than it's been, in part because labor supply isn't likely to grow as rapidly as it had in the past. US and global equities, obviously a major repricing with the downdraft in asset prices over the past year. Starting to bounce back now. The stock market usually leads the real economy, so that could continue to go up even if we're flirting with a recession. But it sort of depends on how much work the Fed has to do. Recessions are a time when we all stop spending at the same time. Maybe we don't stop, but we pull back. And so it is a bit of a self-fulfilling prophecy. So far, consumer confidence is holding up reasonably well, which you'll see in a minute. But those things can change pretty suddenly. So I don't think we're out of the woods as far as equities at this point. I do think by year end they'll be higher than they are today, but we could be in for another repricing before we get to the finish line on that. Household net worth remains very high by any traditional metric. Obviously it came down with the change in asset prices, but the long history there is very positive. Federal debt to GDP continues to remain quite elevated. Obviously, the great financial crisis and then the pandemic were the two recent big surges in debt to GDP ratio. I used to think that this was a bigger problem than it seems to have turned out to be. It's probably a drag on GDP growth, ultimately, with the federal government being that much in the credit markets, crowding out credit that could go to private companies, but so far it doesn't seem calamitous. The Fed balance sheet, I remember when the great financial crisis hit and the Fed doubled their balance sheet and everybody thought, oh my God, what's going to happen with that? That's that little blip in the beginning here. And then you can see what happened to the Fed's balance sheet in the pandemic. Really swelled from about 4 trillion to 8 trillion over the course of a year. So that's just the Fed buying securities with money they don't actually print. It's just electronic bookkeeping entries, but they just go in the credit markets and load up their balance sheet with stuff. So asset prices are higher than they would be if the Fed wasn't intervening. And it isn't just the assets that the Fed chooses to own, because they're all linked through markets. So the Feds and the other central banks around the world are pretty big buyers of assets relative to where they were 30 years ago or even 15 years ago. And so, that was a very clever piece of the playbook that I think central banks thought about when the great financial crisis came along and kind of held the economy together. I don't know what the limits are to that. It seems like one of those things like, well, if it worked well for a while, why doesn't the Fed buy more assets? And I think it's probably what it amounts to is maybe an intergenerational wealth transfer, that the current generation benefits a lot from these elevated asset prices. But if you're not going to keep growing your purchases at the same rate, future generations kind of suffer. And maybe we've taken enough from future generations and we should be a little more reserved about that. Consumer confidence is a big thing to keep an eye on, in my opinion. So where the economy could really go south is if consumers got much more pessimistic. Then we could see the bottom fall out a little bit and unemployment rates really spike. I don't think that's going to happen, but it would be premature to be overly confident about that. That will depend on factors that we're not aware of yet. Like, I don't see anything at the moment that's going to put a huge dent in consumer confidence. Tech firms are announcing layoffs. I don't really know. Are those layoffs? Are those positions that maybe are open that they're now not going to fill? When you just make an announcement like that, there can be some funny math going on there. And if you're an employer, you've lost a lot of leverage with employees, right? I mean, you can't get them to come back to the office. You've lost a lot of leverage with employees. It's nice to announce, hey, we're riffing 10,000 people at Google. And then the people who keep their jobs feel kind of grateful. But I'm not sure they're actually sending 10,000 currently on the payroll people home. And I'm not sure that that's an auditable, when they announce we're getting rid of 10,000 people, who knows? So anyway, I think unemployment is going to edge up. But I still don't see the bottom falling out of this economy. The real thing that is going to determine the fate of the economy is, of course, how rapidly this consumer price inflation continues to come back down to acceptable levels for the Fed, and how much work the Fed needs to do to get it where they want inflation to be, how patient they're willing to be in getting back to 2%, maybe plus or minus a little bit. So inflation on this slide is broken out by sector in the economy. So the first set of bars is the headline CPI, and the second set is the core CPI that takes out food and energy. And each bar is a 12-month change. The first bar is 2019. The second is, 2020. The second is 2021. And the third is 2022. And what you can see is the inflation of 2021 really originated in commodity prices, which were up by 11%, and energy commodities, which were up by almost 50%. So those two areas really were the tip of the inflation spear, so to speak. And now you can see the gray bars that represent 12-month inflation measured as of December 31st, year-end 2022. If you look over at food away from home, food at home, services less energy, services less energy is probably the big category that I would focus on. You can see inflation was barely registering in services a year ago. It was 3.7%. Now it's 7%. And that's driven mainly by labor costs And so until we really get a healing of the labor supply, I think inflation will be a little bit stubborn. So how do we contain inflation and maintain growth? The factors driving inflation now are mainly embedded in wage growth and labor supply. I do think extending flexibility and work from home takes some pressure off wages because workers really value that flexibility. So you don't have to give them as big a raise if you're willing to trade some flexibility. The faster supply recovers, the less draconian the Fed needs to be, and that's going to determine whether we have a recession or not. And I'll show you what I mean by that in pictures. Just on the outlook for inflation, I like to track the Treasury Inflation Protected Securities, or TIPS, 5-year break-even inflation rate. So people who trade in that market are betting on whether inflation's going to be above or below a certain level. And right now the break-even rate on the 5-year average for inflation is a little below 2.5%. So market participants obviously think the Fed is going to eventually get inflation back down to target because we're starting out, with rates above 5% right now. So how do we think about the pandemic? Really, the pandemic at inception was a big shock to both aggregate demand and aggregate supply in the economy. And both those things work to depress output, and they kind of neutralize on inflation, right? We have less supply, but there's also less demand. People can't go out and shop. We were in lockdowns, largely for a couple of months. So that's the initial effect of the pandemic. Then fiscal and monetary policy come along and try to bolster demand, but they can't do anything really about supply. So they add a lot of demand to the economy, but many sectors of the economy still aren't open. So that creates a lot of spending, and people can't meet the demands, and that's what leads to inflation. Then the vaccines come along, and that in theory kind of helps us get back to a more normal full opening. But what's still missing is labor supply hasn't come back to pre-pandemic levels, and that's why we're still grappling with inflation. So I don't want to induce any PTSD, but I'm going to draw some graphs. I haven't taught economics in a long time. This is like static analysis. Forgive me, but those two initial shocks, the supply curve shifting to the left, the demand curve shifting to the left, both of those depress output measured on the vertical axis from Q1 to Q2, and they're kind of neutral on inflation. Nobody's buying anything, nobody's making anything, there's really no inflation to speak of. Maybe in a few areas of the economy where people are still trying to buy necessities and maybe they're doing a little hoarding. So there were pockets of inflation, but not too bad. Then the Fed and the federal government both intervene. The Fed cuts rates to zero, provides a lot of liquidity, as we saw. The federal government's giving people money. In a normal economy, supply creates its own demand. People go work somewhere, the business generates revenue, all the revenue gets paid out to the factors of production, either labor or capital. They share all that revenue. They take that revenue and spend it, there's no inflation, right? We consume what we make. There's no inflation as long as the financial system's kind of stable. Well, when you give people a bunch of money when they didn't make anything, now they're going to spend that money, guess what? That's going to be inflation. It has to be, okay? Unless they saved all the money. They did save some of the money because you couldn't travel initially, right? Leisure and hospitality are still kind of shut down. So all the demand is channeled onto manufactured goods. Everybody's buying stuff for their house, fixing up their house, because they're spending all their time at their house. Now, the people who make stuff for the house know this isn't going on forever, like this is temporary. So they're not expanding capacity, they just raise price. Leisure and hospitality, I thought the prices would come down, but if you tried to get a hotel room when things were sort of shut down, they charge you even more because they knew you must have to travel if you're going to a hotel now. So that there wasn't really any offset there. So that's really where the inflation comes from. And then the hope would be we have vaccines, everything's back to normal. Can't we just get back to where we were now? Yeah, we got to work off maybe some excess savings that people had that still give them maybe more demand than supply is able to generate. I thought by now we'd sort of be worked through that, and we just aren't. And part of the problem is there's about 2.6 million workers that would be back in the workforce if we were at those pre-pandemic participation rates, and they're not. So labor supply is slow to recover. I thought COVID would fade. Last year, I pulled this from my slide, the labor market would normalize by the summer of 2022. Wrong. That was wrong. Low-wage workers are still missing. Bloomberg did a nice snippet on Raj Chetty's in-depth research piece that really identified the major source of the problem is low-wage workers in high-density, high-income urban areas are just not back in the workforce. There's about 20% fewer of them than there were previously. And the US now actually lags in the share of prime-age adults in the workforce relative to other OECD countries. That is a pretty new development for us. You know, we were always the country, everybody thought people in the US work too much. Now there's some people that have apparently rethought that, and I don't know that they're coming back. You know, at some point, the pandemic maybe goes on long enough that people change their values and views about what's important in life, and I think there is a bit of that as well. So my outlook for 2023, there is a possibility of a soft landing, and it really depends on the recovery of the US labor supply and also China's manufacturing sector, if that gets back to humming and supplying the world. I would say that the odds of a technical recession are really at about 50-50 right now. If you read Bloomberg like me, I was comforted yesterday. They said, this is like an impossible year to have to predict the economy. And Dan still made me come today. I don't find it really impossible, actually. I mean, I think it's pretty clear. There's two forces that are creating tension. The Fed's desire to get inflation out of the economy and whether the labor force and other parts of supply can heal quickly enough to bring prices down more naturally, or if the Fed has to move the demand curve all the way back to meet a compromised level of supply. And if they have to do that, that's a recession. And if that becomes self-fulfilling, you know, I'm tempted to say it's really going to be kind of a weak recession if we have one, but that's a dangerous thing to predict too. Because if people turn pessimistic at the same time, you know, the economy relies on confidence, and bankers are shaking their head. Bankers understand that, so it's important, you know, that we do what we can to fortify confidence. I will predict for 2023 1% growth in GDP. Unemployment is going to remain below 5% comfortably. Core inflation by year end will be at 3%, and the S&P will finish at 4,400. Don't trade on any of these things. I don't, you know. I mean, I have to say something. But I do think the way to think about this right now is the Fed is hell-bent on getting inflation down. Keep in mind, it is definitely in the Fed's interest to sound really serious and hawkish about that, because the more markets believe the Fed, the less inflation there will be. So the Fed is trying to manage your expectations too. And they may not be as committed to 2%. So maybe they're going to ease off if they think things are getting out of hand. Okay, so that's why I feel okay about it. I think the rate at which inflation's coming down now gives me a little bit of confidence. You know, if any of my employees are here, don't ask for a very big pay raise. We're going to keep inflation down. Okay. Another interesting thing, remote work has legs. I mean, this is a real thing. Employers thought this was going to be temporary. We're going to bring everybody back to work. I don't know about all of you. I work in the financial services business, the business I run, the UW Foundation Alumni Association. We can do a lot from home. There's a lot of things you can do from home. My people who sell, they can sell from home. Or they go out on the road, but they don't really need to come to the office. I mean, I always felt with my development staff, it's like, you come to the office, you're not raising any money here. You know, none of us are giving you money. So I didn't really understand why we had such a strong culture of the development officers showing up every day if they're not traveling. You know, I don't know that they need to. So anyway, we're we're still very much a remote work place. We hope to have people in 2 days a week. We think especially for new employees, it's kind of nice to meet your colleagues in person and develop that culture. But don't sell short the culture that can be created in a work from home environment, because the one thing I would say about that is meetings are really focused on business and results and making decisions, and then we're off the Zoom, right? In-person meetings, there's a lot of other dynamics. You know, some of my leadership colleagues say, oh, it's really important for people to bump into each other at the office and, you know, brainstorm about things. I mean, like, brainstorm about what? Like Aaron Rodgers' game on Sunday? That's what I hear guys talking about when I go in the restroom, you know? They're not talking about work usually. Maybe some of that's good, you know, it does build culture and connection. And that can build trust. And when there's trust, decisions are more accepted. So maybe some things work better because of that, but I think you can oversell it. So I'm not sure about the impact on culture. My mind is open on that, but I do know this. It's pretty clear, relative to pre-pandemic, there's 6 times as much work from home on a full-time basis. And I don't think that's ever changing, and I think that's just fine. I think that's good for us. The other thing that's really good is U.S. economic dynamism. I talk about this pretty much every year. The new big thing that you've been hearing about is ChatGPT, artificial intelligence. I have the app on my phone. I can type in something like, please write a strategic plan for an organization that raises funds for a research university. And in 10 seconds, I have a 5-point plan with subpoints on all 5 of those points. And you look at it, I'm going to give it to my executive committee when we meet next week to talk about strategy and see what they think. And then I'll give them like what I actually think our plan should be. But I'll see if they notice that this was just something generated by artificial intelligence. We are still a really dynamic economy. Again, you can see even with all the correction in values and the tech crisis, the biggest companies in America are the ones founded after 1975. NVIDIA's making a nice appearance on here. They're going to be a big winner from the ChatGPT and AI revolution, and we'll see how that trickles through various businesses. If you haven't downloaded one of the chat apps, there's several of them that can do really well, and you just type in the prompt, and you'll be amazed how quickly it spits out answers. So I asked ChatGPT to tell me the reasons to live in Wisconsin, and it was remarkable. I mean, stunning rolling countryside, abundant outdoor recreational activities, and it mentions them all. You know, I didn't put the whole thing on here. Affordable cost of living, education. Wisconsin has some of the best public and private universities, as well as highly rated public school districts. Jobs, we have a diverse and healthy economy. Easy access to Chicago, Minneapolis, and of course our own Milwaukee. So then I asked it for a 2023 economic outlook. It was total BS. And then somebody told me it's because they only have data in here through 2021. So ChatGPT was operating off of the wrong baseline, wildly optimistic for 2023, didn't even know we've had inflation, thinks the stock market is still at all-time highs. So apparently I am not yet replaced by ChatGPT, Dan. So here we are. I have 40 seconds left. I'm going to conclude with some of the long-term challenges. There's a battle in the world going on between authoritarianism and democracy. That is something to pay careful attention to. I think the U.S. has to do a much better job building bridges in the Americas. We should have better relationships with Mexico and South America, Brazil. These are economies that can replace a lot of what we have relied on China to do, and I think we've kind of ignored them, and it's time we invested more. Federal debt and the dollar's dominance is something to keep an eye on. Our politics, I don't even want to talk about it. We're going to look back on this last decade of political leadership someday and say, wow, how did that happen? The carbon transition is going to be a headwind in the economy. So the unwinding of globalization and the attempt to shift to non-carbon fuels, those will be headwinds, and that's why the new normal for real GDP growth is going to be lower. The Fed, some people say that's inflationary. What it really does is it slows down the potential growth rate. If the Fed wants inflation to be 2%, that's what it's going to be. That can be whatever, but we will have a slower growing baseline in the economy. Our opportunities are greater cohesion in the European Union and the Americas, our technological leadership, and yeah, we don't have a very sane immigration policy right now, and that's part of the reason we're short so many workers. You know, I've said this before, I don't know why the United States of America doesn't recruit workers and people the way the Wisconsin Badger football team recruits players. We sort of, it would be as if the Badgers waited to see who showed up on campus and we throw together a team. You know, we're in a pitched battle against authoritarian countries for global leadership. And we shouldn't be, you know, agnostic about our immigration policy. Yes, we should welcome a certain number of people for humanitarian reasons, but we should be recruiting the best people to drive an entrepreneurial and innovative economy. That would help a lot. Maybe Republicans and Democrats could agree on that. I won't hold my breath. Thank you. It's always a pleasure to be here. Have a great week.